Welcome to TheoTrade. This is Don Kaufman. June 13th, 2022, Carnage just gripping hold in the markets for today's trading session. Oh, this is a Monday we're not going to soon forget. The S&P's down by 4%. The Nasdaq just off by about 4.7%. These are all what we would kind of term really statistically viable moves in the overall marketplace. Listen, here on this evening's video, we're not going to talk about exactly what had transpired today. What's important at this point, but in this moment in time, is what you should anticipate moving forward. One of the aspects we do have to cover right up front, though, is what, in my opinion, is really the driving force behind some of the move, and really some of the areas of almost like dislocation in the marketplace that you have to be incredibly concerned about moving forward. Let's get started here on this evening's video, a fairly extraordinary trading session. I mean, who would have thought the S&Ps, and again, I'll cruise over to the S&P futures trading, okay? What, 4,100 and change just 3 sessions ago. All of this transpiring in such an incredibly short period of time. Of course, everybody wants to know at this point, the S&Ps just fell from 4,100 to 3,750. What's next? And that's, again, it's exactly what we're going to be covering here. One of the first things that has to be mentioned, let's just move right along away from the S&Ps. We're going to look at volatility in a minute. We're going to look at dollar, okay? You have to take a look at the bond market. Specifically, we're looking at the ZB in this particular case. It's one of the more extraordinary moves that we have seen, but let's put it in a little perspective and also take a look at the ZN, which are the notes. Now, those of you that are not per se familiar with bonds or notes, that's all right. I think everybody is, though, familiar with interest rate. If we take a look at TNX, something we've been mentioning kind of day in and day out recently, okay, that the setup for interest rates to absolutely explode to the upside wasn't just prevalent, that it was likely to happen. We have seen precisely that. But taking a look at like this 9-month charter, all right, so rates exploded in the 10 years trading, at 3.36. That doesn't do it justice. I want you to go ahead and open up like a max chart. When you start to look, okay, at a max chart, in this particular case, my max chart is actually based on a monthly. It is the single largest, most parabolic move that anyone has seen, okay, in interest rates in recent history. This is something that even at this point in time, if rates were to just turn around and collapse back down, unfortunately, the damage has already, okay, occurred. It's probably one of the things that at this point, like if you're talking about putting some risk on right now, we're going to bounce. This may actually stave off a lot of investors and a lot of traders. Anyone that understands the implications, okay, of the 10-year, that again, we are looking at a monthly. In the last 3 months was sitting roughly at 1.8%. And now effectively is at 3.3%. Or, okay, another way to put this, look at the year to date on a 10-year. That is up 100% on the year. So again, the cause for concern for a lot of people, of course, is it's inflation here, it's inflation there. At this particular point in time, you have to worry about the rates. They overshot, they exploded. Okay, this is now going to take us to a recession, stagflation. Again, a lot of the aspects that we covered on, okay, this past weekend update. Bonds, first and foremost, need to be assessed in this particular case because the movement over here is just downright dire. Why are we looking so much at them? Because the next move in the bonds is going to define what we are in the S&Ps. It's going to define what we are inside of the Nasdaq. Any continued sell side activity inside of the bond market, I think you have to assume at that point that the S&Ps are going to absolutely crater. And that's when everybody looks at this and they go, oh, it's already down 4%, man. What are you talking about? Okay. Again, this is about inflicting dramatic change to the entire marketplace. And that the fact that the bonds are coming off so hard and so fast, okay, that it is going to inflict, again, never-ending carnage to the S&Ps so long as we continue to see sell side in the ZB or sell side inside, of course, these notes. It's the single most definitive factor, okay, to move forward. For those of you that don't necessarily look, okay, at the ZN or the ZB, it's also very notable, not just a dramatic move inside of HYG. For those of you, again, that do not know this marketplace, this is high yield, better known as junk. Junk, again, on a broader note, bringing up a 5-year. It's an outright crash. The only thing on magnitude to compare this to, of course, is the COVID crash. But at this point in time, again, some of the most dramatic moves that have been seen in recent history, specifically inside of the bond market, I cannot stress enough, okay, that the 10-year exploding to the upside, again, will continue to inflict pain to the marketplace. Unfortunately, incredible damage has been done. As I said, even if those bonds were to rally back up, okay, this is something that's just going to kind of tear a hole in the fabric of the S&Ps and even more appropriately the Nasdaq for a very considerable period of time. All right, let's spin it back around for just a moment and cruise back over to the SPX. The reason that the SPX is of critical, okay, point to be made here, we've already crossed outside, okay, of the expected move on the week. Now, something we look at kind of week in and week out, of course, are these expected moves. And for those of you that are unfamiliar with the idea of expected move, here is ultimately where what last week ended. Of course, this week began, okay? The lower edge of the expected move this week is approximately 131 points. So when you look at the expected move, it's plus or minus, okay, 131 points on the week. Where are we right now? We've already crested through the lower edge of the expected move. You go, okay, but that's, you know, again, this is in hindsight. It's in hindsight. Now, these lines are going to kind of resonate with us throughout the course of the entire week. In fact, I want to get really specific. The lower edge of the expected move, just round it. It's roughly sitting at about 37.70, okay? One of the key points to be made moving forward is that not that we're outside the expected move. It's that the remainder of the week has actually blossomed up to 150 points. So bear with me in this thought. You just passed through an entire trading session, okay? And yet, not only didn't the options decay, they actually added value. I mean, that's what expected move is. So now we're sitting on this 150 point expected move, right? So expected move has actually grown. And that, okay, in literal sense means from this point forward, we can move another 150 points. I mean, you know, how bold of a move is that? It's critical. Again, that's why I say, you know, critical points to be made. So if you're going to see some more sell side inside of the bond market, you better believe that the S&Ps, they're going to be rocking out there. I mean, there's not that much more that this marketplace can take. Now, at this point, of course, everybody is trying to get strategic and they're like, well, I'm going to play this market for the bounce. Okay. All right. And that's fair. Like, it's a fair assumption. You just had a S&Ps collapse over a 3-day window. And this is what we call like a complete and utter repricing of the marketplace, right? So they just collapse over a 3-day window and everybody's looking for the bounce. You're going to get it. Okay. Listen, I'm not here to distinguish whether we're going higher or lower. One of the things I talked about in the weekend update was the fact that there was upside potential, but the downside risk, okay, wasn't just, again, dramatic. It was, you know, the void. It was, again, hanging over into the abyss. And that's exactly what we've seen over here. The next move, as I said, is going to be defined by the bonds. So there's no levels here. You need to forget about levels. This is volatility. With that actually being said, again, if you're looking for a bounce, I'm fine with it. You must define your risk. If you're going to use, like if you're just going to go out there and buy stock or buy futures, you're going to get run over. I mean, do you realize you could actually wake up and the S&Ps could be down 200 handles? that we moved right now. You can see about a 3.7% move, and overnight limit down is 7%. That quite literally, the move here could be almost as much as 300 points before we even hit a limit down event. You go, it's impossible. It's not going to happen. Okay. But mind you, there's a couple of warning signs on the screen right now. And this is the kind of thing as a trader, an investor, anybody involved in this market, this market is, as I said, it's carnage and it's just gripping hold. Let me take a look right here at VIX. VIX absolutely went parabolic in the last 3 days. Mind you, it's only at 34, right? We actually start to open this to a larger time frame. Do you feel special at this point? VIX could easily crest into the mid 40s from here. And before whatever type of volatility event this is, I think you have to anticipate that it's going to crest at minimum over 40. So those of you that are trying to get bullish, and again, I'm not discounting the ability for us to rally. What I am doing though, okay, is simply noting that volatility, my opinion, just kind of caught its stride. But to get into the 40, okay, even mid 40 region, that would be real fear and loathing in this marketplace. Clearly, okay, people have looked at the volatility futures, which went from a big time contango. All of a sudden, we're in backwardation. I mean, the signs of the risk are everywhere on this screen, okay? But again, VIX, even though it goes parabolic to close the day at 34, you're like, it's up 22%. I agree. It's a decent sized move, but it's not the move, okay, that you probably would have anticipated, if you will, when you look at the S&Ps and recognize how substantial the collapse has actually been. I mean, what's 350, okay, almost 400 S&P points amongst friends. You do realize that this was a 4,000. I mean, you're looking at a 10% down move in the S&Ps, and the VIX just catches its stride at about 34. Doesn't look right. Definitely nervous with volatility exploding to the upside. Obviously, tech getting hit across the board. Listen, a day like this, there's nowhere to run to, nowhere to hide. It's complete and utter, okay, capitulation, across the board correlation. But at the same time, as I just used that term capitulation, it's just not there yet, right? Down to the bottom of the screen. Of course, this day would not be complete without a brief and fleeting discussion of Bitcoin and what has happened inside of the crypto market as a whole. Rather than actually review with everything that transpired in Celsius, okay, there is right now, if you will, okay, a very much systematic risk underway in crypto markets. Crypto markets, okay, something that's effectively similar to a bank on the crypto side, which is Celsius. They locked up, they stopped, okay, transactions. There is a lack of trust, lack of faith in this marketplace presently. Again, Bitcoin specifically down just about 20%. At the present time, what I prefer to look at isn't just price, where I'm like, okay, Bitcoin, and more specifically, here's the Bitcoin ETF. I much prefer to come under here under studies, go add study, go volatility studies, and cruise up to implied volatility. Again, a little bit of a warning shot for all of you that are trying to catch, if you will, a bottom in the crypto market. Recognize volatility, okay, hasn't even hit, all right, its other recent peak. That does not bode well for the overall crypto marketplace. Volatility exploded. It's a full-blown crash. But at the exact same time that we're saying that, okay, that the volatility, it's exploding, it's only really come back to where it was, right? Just a few weeks ago in the last, okay, kind of version of crypto coming apart at the seams. This is now part 2. There could still be very considerable degrees of risk. Implied volatility is screaming just that. Listen, there's a tremendous amount to think about okay, in a trading session like this. And people constantly ask me, what I do in a trading session like this, positioned for it. I don't have anything too substantial on, but I've been positioned for a move like this for a considerable period of time. Did I fill a lot of stuff? Nah, I rolled a couple of positions, did a little dance, made a little love, got down tonight, sold a couple of bond puts in the midst of here, sold the 119 puts, sold the 115 puts, rolled a bunch of profitable positions, closed profitable position of calls that I had sold, okay? And people are going to ask, how come I didn't open a bunch of new stuff out there? As I just said a moment ago, VIX, it's just not doing it for me. Skew definitely came up, but I think in the next couple of days, we could actually see risk, okay, even exacerbate some of the moves that we've already seen. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.